I'm Enron, and I need loans from the bank, so I'm going to make my financial statements look much better than they should in reality. I'm Anderson Accounting Firm, and I'm going to issue Enron unqualified opinions for the next 15 years, as well as offering them both consulting and auditing services at the same time. I'm going to use these special purpose entities and I'm going to sell them my product at a huge gain. I'm also going to use them for debt avoidance and I'm going to do that with my own common stock. So I'm going to be able to claim my increase in common stock as a gain for the first time. And these SPEs do not need to be mentioned on my financial statements. I'm the SEC, and I'm not too sure what to do about SPEs, so I'm going to institute the 3% rule in hopes that it will curb the practice. So 3% of the SPE's equity must come from an outside source. It is not going to curb the practice. I'm going to make hundreds of SPEs, and I'm going to have outside investors invest exactly 3%, and many of my executives are going to get rich off of these SPEs. And I'm going to continue to do that until I have to issue a $1.2 billion reduction in my company's equity and assets and eventually declare bankruptcy. And my company is also going to go bankrupt. Alright, now the SPEs need to be mentioned on your financial statements, and you can't offer a client both auditing and consulting services at the same time. When you are all done, the result had better reflect what you see in reality.
And so now that you've heard our case summary, on to question one. And this lists the parties involved. So we first have Enron executives, Arthur Anderson, and regulators. These are all people we believe to be responsible to some degree. So Enron executives, they engaged in fraudulent accounting, misleading the investors through off-balance sheet entities, and manipulated financial statements to inflate profits. We also believe Arthur Anderson, the external auditors of the company, failed to maintain independence and professional skepticism. Anderson approved misleading financial statements and destroyed audit documents, violating all sorts of different ethical standards. And lastly, the regulators. My team believes that the SEC were slow to respond to red flags and failed to detect the accounting manipulation early, which led to a lot of the errors and issues that we had with Enron. So, justification, each of these parties either directly participated in or failed to present unethical reporting practices, eroding public confidence in financial reporting and auditing. On to question two. These are different types of consulting service threats that come with consulting services. We have internal audit outsourcing, tax consulting and planning, and IT system design and implementation. All these are consulting services, but they all have their own threats. So, with the first one, the audit firm designs and monitors the client's internal controls, but it creates a self-review threat because auditors might audit their own work, which you don't want to happen due to the fact that auditors can just say, oh yeah, that's good, because they did it. So we don't want that. Next one is tax consulting and planning. Advising on tax structures that affect financial reporting poses a management's participation threat if the firm makes decisions on the client's behalf.
Question 4. Key requirements for prep and retention of audit files. Work papers must document the procedures performed, evidence obtained, and conclusions reached. So essentially, every step of the audit that you conduct needs to be documented on your work papers so the next person that follows can see step by step your thought process and what you completed. They must be retained for at least 7 years per SOC Section 103. Work papers must be prepared promptly after fieldwork to support the audit opinion. And as for ownership, the audit firm owns the work papers, not the client. The client may access them under limited legal circumstances only. Question 5. How independent auditing has been strengthened. One way is through mandatory audit partner rotation. This reduces familiarity threats and is supported to encourage fresh perspectives. Next is the prohibition on certain non-audit services. This prevents self-review threats and is as well strongly supported. Next is audit committee oversight of auditors. This enhances independence by aligning auditors with shareholders, and this as well was supported. Next is enhanced disclosure of audit fees. This promotes transparency between the auditor and the client to ensure that both are fully aware of the audit fees that will partake during the audit. This was supported. Lastly is the establishment of the Public Company Accounting Oversight Board. This provides independent oversight of auditors and is strongly supported. Each measure reinforces independence and accountability within the audit profession. Question 6. How was professionalism evolved over the past decades? Historically, professionalism emphasized technical competence. Today, it includes ethical responsibility, independence, and accountability. Key changes resulted from scandals such as Enron, WorldCom, that led to the Sarbanes-Oxley Act of 2002. And it also led to the creation of the Public Company Accounting Oversight Board. The concept now integrates transparency, public interest, and continuous professional education as cornerstones of ethical conduct.
Auditors do have responsibilities when it comes to the quarterly financial statements. Firstly, auditors read and review the quarterly financial statements. They ask management about large changes and substantial events that can affect the financials of the company, and they make sure financial statements comply with regulations. Now, all things considered, no, quarterly financial statements should not need to be audited. Firstly, it'll add to the workload of accountants. There's already a shortage of accountants, and being a CPA is already a stressful job, so adding to the workload will only increase the stress and make accounting less desirable. Secondly, this will add to the expenses of a company. Now, it might not seem like much, but just a small increase in cost can make or break a business. And these added expenses will only eat into profits and possibly make prices increase. Thirdly, there's only because of human self limits, there's only a certain amount of auditing someone can do in a year, and so this limitation will add scarcity and therefore increase costs even more. And this difference can make starting and maintaining a business much, much harder for people. Alright, that's our presentation. I've been James Foley with Cade Horning and Addison Tao. Thank you for listening. Goodbye.